Okay, welcome back to our channel, MegaWhale. Thanks for tuning into another video. Today's video is going to be a Bitcoin update. We're going to be talking about, are we going to see a bounce here or are we going to continue further? And if we do reach down to 24,000, will we bottom out of 24,000 or will we drop lower? Those are the two questions we're going to answer in today's video. So if you're interested in a detailed analysis, stick around to the end of the video. We're also going to answer a question submitted by one of our followers. He asks, as a trader who has a basic understanding of risk management and uses stop losses and understands TA, how do you control your emotions in this market? We're going to answer that at the end of the video, so make sure to stick around. Let's go ahead and dive right in. So to start with, guys, Bitcoin is looking not too bad. It's dropped down below this major uptrending support line we can see over here at around $30,000. It crashed below, found a little bit of support at around 26, pushed upwards, and has recently broken above this major resistance support zone. This does not mean we are bullish. This is just a bounce, and I think we need to drop our expectations immediately to start off with. We do not want to get the FOMO. We do not want to get too excited on this move. At the moment, nothing significant has happened. We have not even cleared this previous daily candle open, which is over here. $31,000. If we can clear $31,000 and push upwards here, we could see a move upwards to 36. So my bullish short-term prediction is $36,000. I'm going to go ahead and show you why I believe that on the small time frame. So as we can see over here on the Bitcoin time frame, we have an ascending broadening wedge. And you may not be able to spot this immediately, but I'm going to go ahead and draw it out for you. So we have this downward sloping resistance, and we have this downward sloping support. And a descending broadening wedge is where you have the resistance and support expanding in distance as the trend moves downwards. This is a bullish reversal pattern. Now, where do these patterns usually result the price going to? Well, it's very simple. They usually enter to the entry. So we should see a price move upwards to that entry point over here. Where does that sit? 35,000, right under this major support zone, meaning we could see a wick in and then back down, continuing down. That would be the bearish scenario. Let's go ahead and take a look at that bullish scenario on the larger time frame. And we've been talking about this for a long time, guys. The bullish scenario, we need to break above the 100, we need to break above the 200, and we need to get some candles above this local high over here. If the price can go ahead and get over here and flip, this will send us into a new all-time high, a new bullish uptrend, and we could definitely push nice and high. Until then, do not invest with a lot of money. Stay safe, continue to scalp trade, and don't have your expectations too high, because if we've seen anything in the last few days with the UST thing and the Luna thing, it can come toppling down quicker than you can imagine. All right, so be aware of the risks, be cautious, and don't over position yourself. So the bearish scenario, of course, guys, is if this daily candle fails to close, and I'm going to say fails to close above this daily open at 31,000. If it fails to close above that daily open, we can see this candle drop back down, potentially reject, and head down to 24,000. Now, no one ever said that we're going to reach $24,000 in May. My prediction was in July. We still have a lot of time. There's still a lot of time. We could see a push upwards here, some sideways price action, and a continuation down. There's no reason saying we can't do that, all right? Do not expect the price to drop immediately down and straight it down. Usually it goes in a stairway. It goes down a little bit, up a little bit, down a little bit, up a little bit. It's just how it is. So don't look at this and say, oh, MegaWhale, we haven't hit your 24,000 target. That was the 11th of July, guys. So there's still a lot of time. It is very, very close. We actually ended up hitting $24,000 on Bitcoin on a few different exchanges. I know Bybit actually hit 24,600. Binance's chart only hit 26,500. So some Bitcoin charts actually already hit 24K. Really interesting. Let's go ahead and take a look at the total cryptocurrency market cap, and we can see a few scenarios over here. And I want to just go ahead and identify we are in this horizontal resistance support range, this chop zone. And we are going to make a significant move depending on the direction we break. If we lose 1.2 trillion, we're going to see a significant drop. All right. If we lose and break, or should I say, if we break above 1.4 trillion, we will see a move back upwards to 1.6. How can you utilize this information? Well, we already know that the total cryptocurrency market cap takes in consideration both altcoins as well as Bitcoin's market capitalization. Therefore, it's safe to assume when this rises, generally the cryptocurrency market rises. It generally goes up. So we can assume if we break above 1.4 trillion, this major resistance, the market will have some sort of relief, some sort of bounce, and we will continue upwards. The only reason we're bouncing here is because the total cryptocurrency market cap has reached a significant level of support at 1.2 trillion. I'm going to go ahead and flip the chart and show you something here. We have, if I zoom out, we have a huge formation over here, which is almost a resemblant of what you would call an Adam and Eve. Not quite a perfect Adam and Eve, but is almost resemblant of Adam and Eve, or at least some kind of rounding bottom. And we do have this neckline over here. And this is really the most important thing I do want to pinpoint. I don't really care about the formation over here. It isn't a very, I wouldn't say isn't a very smooth or very accurate formation in regards to rounding bottom. We do have this kink over here, which can happen, but it's not the best when it comes to rounding bottoms. What I want to really draw your attention to is this neckline. And the reason being is because this neckline is showing us a significant support resistance zone. If we flip the chart, we can see that if we do break above this level, we really are going to be pushing quite high over here, in the sense that we are going to be dropping quite low down. So I do want you to keep an eye on that. We could definitely come all the way downwards, guys, to around 800, 700, even potentially 600 billion on the market cap if we lose this level. Bitcoin dominance, on the other hand, has broken upwards, and we talked a lot about Bitcoin dominance, and we've been talking about Bitcoin dominance since February, and we've been warning you guys that we're going to see a break upwards eventually. It was a downward sloping resistance, all right, followed by this retest, consistent retest of this major support zone will eventually result in a break upwards. We've seen that break upwards, and we've seen altcoins significantly suffer. Remember, guys, we said if Bitcoin dominance breaks upwards, altcoins will bleed heavily. Look what happened to the market the other day. Altcoins were dropping 50, 60%, some 30, some 40. Nevertheless, altcoins got absolutely hammered, and this could continue upwards. I'm not saying it's going to. I haven't really looked at it since then. We have clearly found a little bit of resistance over here, but it could definitely continue upwards if the market drops any further. If total cryptocurrency market cap drops over here, if Bitcoin drops over here, this will continue upwards. Altcoins will bleed in comparison to Bitcoin. Where is the next major resistance? You guessed it, it was over here at 50%. So it's still a while to go, guys, still a while to go. Before we get into our technical analysis, I just want to give Bitget a bit of a shout out. Bitget, a bit of a shout out. I wanted to quickly introduce my new favorite exchange, Bitget. Bitget is a non-KYC exchange, which is particularly beneficial for members in the UK and Australia who are limited by certain trade restrictions. Bitget has 250 plus spot trading pairs, as well as 60 plus leverage trading pairs, up to 125x leverage. Sign up now in the link in the description using our referral code to get up to $153 in rewards for completing 4 separate tasks. Let's go ahead and dive back into the video. So we're going to go ahead and talk about our technical analysis next, talking about our weekly, talking about our 3-day, our 1-day, and then breaking it down to a smaller time frame. So to start off with, the Ichimoku cloud is suggesting, of course, we are in a very significant downtrend. Our indicators are suggesting sell. We do have our lagging span below our clouds, our conversion baseline above our price, and the price below the clouds. Definitely not looking very healthy. Moving on, bull market support band, exactly the same thing, guys. We're trending downwards, we're getting rejected, it is not looking very good. And all these indicators are going to be suggesting the same thing. We have officially lost, or in the last 7 days at least, we have dropped down below the Gaussian channel, and we've been warning you guys about this Gaussian channel drop ever since we entered it on the 3rd of December. We've told you, we enter the Gaussian channel, we will go through the Gaussian channel. And I told you this on the 3rd of December, and even before it, just like we have seen in the past many times. When we enter the Gaussian channel, we go directly through the Gaussian channel. What does this mean, guys? It means that according to historical data, we're getting close to a theoretical bottom. And we're going to talk a little bit more about that in a minute when we go look at our Brave New Coin Liquid Index. We're getting close to a theoretical bottom. The question is, will the theoretical bottom hold, or will we drop lower? And that's what we're going to answer later on in today's video. Really important we go ahead and watch that. So 7-day, obviously we do have that 200-day moving average. We're going to talk about that later. That is at $24,000. Our 100-day moving average we got massively rejected on, and you can see every time we lose this 100-day moving average, no surprise, we see a big crash, bang, no surprise, we see a big crash, right? We saw it again. History repeats itself. Nothing special, nothing new, all right? Nothing new. Moving on from there, guys, we're going to go ahead and take a look at the RSI. So we'll bring up that RSI on that 7-day chart. And we can see one thing on the RSI is that we've dropped some major support zones on RSI. We have that 34.34 on that RSI, and I'm going to go ahead and chuck that in, and we'll go to that 3-day chart again. But what you can notice on this, and that's not exactly 34.34, but what I can do is I can just go ahead and put this in over here. That's better. What we can see is that every time we drop below the 34.34, we see the price has actually significantly dropped as well. And I had one of my subscribers, one subscriber asks, Whale, how are they related? How is price action related to the RSI? Wouldn't it be the other way around? Wouldn't it be the RSI drops below the 34.34 because the price has crashed? And both of these statements are essentially true. But what I like to say is that RSI measures different to price. It doesn't measure price. We have to keep that in mind. If they both measured price, then you would be correct. RSI measures momentum. It doesn't have anything to do with price. It doesn't care about price. What it suggests is when the RSI drops below these major diagonal horizontal resistances, it means there's been a shift in momentum, all right? Either a positive or a negative. And when we have these shifts in momentum, breaking these massive resistances or supports on RSI, we have these significant shifts. And these significant shifts in momentum allow the price to have these explosive moves. And that is why the price generally moves after, right? Not at the same time, it generally moves after RSI breakouts or breakdowns because you have the momentum on the side. All right, so if we go ahead and look at the 3-day chart now, you'll see every time we lose the 34.34 on RSI, we have that momentum on our side. We can see in this scenario over here, we lost it on the 4th. And yeah, we had this crash on the 4th, but look what happened after. We had this massive crash down. That negative momentum was on our side. We can move it back. Look what happened over here. Same thing, we lost it. All right, we lost it up over here on the 16th, but then we were followed by a 20% drop. And I can show you many accounts of this. We can go further back, even to the COVID crash. The same thing. We always lose it first. We lost it over here on the 7th. We crashed again. And I can go further back. We'll show you one more again. We lost it on the 10th or the 12th of November, all right, on this red candle, and we were followed by a significant 40% drop. So yes, they do go hand in hand. Yes, they can be used together, but it's always important to remember the RSI will always show you warning signs, and I use it to confirm. I always use the RSI to validate my moves or confirm my decisions, because momentum is one of the most important factors in whether a price will move up or down. You need momentum, and if you have positive momentum, the price will generally move up, provided your other indicators and market structures provide or cultivate a scenario which will allow it. And if your momentum flips to the downside as you start breaking these supports, it will signify huge crashes coming, which is why that 34.34 on RSI is so effective. So moving on from there, Ichimoku Cloud. Again, not suggesting too much, really just going off that 3-day, the same thing. Bull market support band, pretty much telling us the same thing from that weekly. And if we go ahead and look at our moving averages, they're pretty much going to be telling us that same thing that they've already told us, which is we're going to 24K and we're bearish. And then of course, if we go ahead and bring up the Gaussian channel, it's going to tell us pretty much the same thing, guys, that we are very much bearish. And I do want to make a distinction that just because we are under the Gaussian channel, it doesn't mean that we are going to bounce back up. All right, just like when we are over, here we go. Just like we're under the Gaussian channel here, it didn't mean we're going to bounce back up. We went all the way down. All right, we stayed under the Gaussian channel. All right, so just because we're under the Gaussian channel now, it doesn't mean we're bouncing back up. We could travel below this Gaussian channel the entire time. That is definitely something to consider. Of course, that is speculation. We can't say that for sure. It only develops as the trend moves. Let's go to a 1-day chart next. So a 1-day chart, we're going to go ahead and bring up the Ichimoku now. And we can see one really cool thing on Ichimoku, which we had this support retest of this uptrending support line. This is a bullish sign. This is one of the bullish signs from the Ichimoku Cloud, suggesting that we could find some support here. Of course, we do have a major support zone right over here, which is really important, which we are keeping an eye on. Bull market support band, again, suggesting nothing different. Nothing different. These are lagging indicators. It will take a reversal in price before we start to look bullish. And it's really important that you understand this right now, guys, is that these indicators are lagging. All indicators are lagging. It will take time. It will take a significant move in price for them to start looking bullish. So we can't base our expectation off the indicators right now alone. We have to assume certain things. And the first thing is we assume is that when we're in an area of support, we'd expect it is more probable for us to bounce than it is to fall through. So we're expecting a bounce here. I don't think it's going to happen. I'm more towards the downside still. So macro still looks awful, but I wouldn't be surprised if we see a move up. And we said already at the start of the video, $35,000 to $36,000 is probably, if we do bounce, a short-term target. I would not be betting on it. I would be looking at taking some small scalps, maybe a small amount of money invested, but nothing too significant. And if you want some assistance with your scalp trading, we have a VIP channel over on over on Telegram, and you can head over and click the links in the description down below to join that. I'm going to bring it up on screen now. You can see we've been scalp trading this bump in the last few days. We've made just today a lot of profit. We did 21% on API 3, 33% on C98, 20% on Mover, 14% on Atom. We had some nice profits. So if you're interested in that, head over to the link in the description, click the Telegram link, and you can contact me for VIP. Let's go ahead and talk about the Brave New Coin Liquid Index and the DXY. We're going to talk about these in conjunction. So first and foremost, this is a really cool chart. This is one of my favorite charts, and it's a chart that I use to predict the top all the way back in November, because we had this retest rejection of this uptrending line. And the reason I was able to call the top, because every single time we have this blow off top, we come down, all right, we come down, we come up, and we reject from this line again before we go down to the bottom. We can see it again over here, come up, reject, and we go down to the bottom. And one more time, up, reject, and we go down to the bottom, all right? And where is the bottom? The 200-day moving average. Now, I do want to point out, 2 of the 3 times we've retested that 200-day moving average, we have dropped through the 200-day moving average and retested this lower line, which is this uptrending diagonal support line. Where is that uptrending diagonal support line? Let's go ahead and take a look. So if we take a look and do a vertical line from the 11th of July, which is where we think the price will bottom, all right? This is sitting at around $16,900. So we can assuming we bottom any time between now, the 11th of July, and we're going to go ahead and double that. So that is over here. We can assume a price target of anywhere between 16,900 and 18,500 for a possible wick. All right, we say a possible wick. This is a possible wick down into this range. We're going to go ahead and get rid of those lines now, right? So what I mean by that is if you take a look at these examples over here, we can see the price actually falls right through the 200-day moving average, crashes down, retests this trend line, wicks back up. New trend restarts, new uptrend begins. Same thing here. We crash down, we retest, push up, new uptrend begins. There's definitely a chance we could see something like that. All right, we break this level, we push down, we wick, we push up, new uptrend begins. What I'd be worried about, guys, is if we lose this uptrending support line. This black line here, if we lose this uptrending support line, technically we have lost a very major market pattern on Bitcoin, that one that we have established and been basically trending in since 2013, the 5th of May 2013. What's that, nearly 10 years? So if we lose below this 16,500 to 18,900, we are technically in a macro downtrend. Like we're talking bigger than the macro we've been talking about before. This is a yearly long downtrend. And who knows what can happen? Who knows what can happen? I'm not even gonna assume that we can go down there. My predictions remain valid to historic price action of Bitcoin. I assume that we're gonna remain consistent to what we've seen before. But if we do lose this level, it is basically no man's land. It's really hard to say what could happen. We could possibly go as low as $12,000. And the reason I say $12,000, if we go to our daily chart and we do our measured move analysis, and we're just gonna go ahead and bring up a few lines over here, since I did get rid of them in our previous video, which is this line here. And this line here, this is our ascending channel. If we draw a line from the top to the bottom, this is called a measured move, copy and paste it over and apply it to that breakdown point, we can see that price reaches 11 to 12,000. So that is that lowest target. So my assumption is, and this is an assumption, if we lose a 24K, we lose this uptrending trend line, the price could come down to around $12,000. All right, we're gonna go ahead and put that in over here, $12,000, which is this level here. That would be retesting, let's bring it up to 12,000. That would be retesting the local high we made here. It'd also be retesting that all-time high on that weekly chart that we made in 2019. And it would be retesting the resistance which we made on the 5th of March 2018. So a triple resistance point, and we could bounce upwards from there, and who knows what can happen. Now, obviously, whether or not we break down is entirely dependent on the global economy. There's a lot of factors that go into play when it comes into talking about asset prices, particularly risk asset prices. And the DXY is a chart that represents how much strength is there in the US dollar in comparison to asset prices or assets in general. So when the DXY moves upwards, we know money is flowing in, all right? And when DXY moves downwards, we know cash or money is flowing out, all right? And where does it flow? It flows into assets. So where does it flow in from? Assets, out to assets, all right? We have broken out of a 21-year long downtrend, symmetrical triangle formation. If this has a measured move analysis, we will see a price target for the DXY of around 150, all right? If we see 150, that's a global economic crash, all right? We see all assets price crash. A lot of bad things are gonna happen. I'm not gonna say that's gonna happen. It's really hard to apply a standard analysis onto the DXY just because there's so many external factors that what this is suggesting, what I've been talking about ever since, over here, is that we will break upwards, which we have, and we could continue much higher. And I think that's what you need to really just understand from this, is we could continue much higher. All right, so what I do want to talk about next is this chart here, and hopefully it zooms in. And this is kind of what we use to predict or talk about how I understood how asset prices are negatively affected by the DXY. And of course, this is relevant, guys, because the CPI came out saying 8.3%. So it is getting higher and higher. The inflation is getting higher and higher. But how does that make sense when interest rates are rising? Well, they're not rising fast enough, and they're not rising by enough to combat the increasing printing and debt obligations which the governments have been taking on. The governments are still funding economic growth through debt and still funding economic growth through inflation. And I said it in my last video that funding economic growth through debt is a very standard practice for governments. It is not an abnormal thing to see, and it definitely isn't a bad thing. It's only a bad thing when they use it in excess or use it incorrectly or at the wrong time, which is now. All right, all governments fund economic growth through debt. It is completely normal. The problem is that we're in a situation now where interest rates have massively ramped up. The cost of goods have massively ramped up because of the inflation, all right? And now interest rates are having to rise to decrease the effect inflation has had on the economy. Now, this is where it becomes tricky because we have increasing inflation, all right? Increasing inflation, therefore interest rates need to rise, all right? So to drop the inflation, all right, we need to rise interest rates, which is happening. But at the moment, there's a disconnect because the practices that are causing the inflation have not been adjusted. So we're in a situation now where inflation is continuing upwards and interest rates are rising. This leads to something called stagflation, all right? This leads to something called stagflation. So we have increased interest on debt, and this affects retail. This affects companies, whether you are a company that has acquired assets on debt, which you probably would have if you're a large company. You'd have a massive balance sheet full of assets which you've acquired on low credit money when interest rates are very low. And now that interest rates are rising, you have to pay more money back into those debt obligations, and your debt to service ratio starts to decrease. Your available cash flows start to decrease. Your cash flow earnings, your future earnings start to decrease. Thus, investors start asking for lower premiums and your company's stocks crash. All right. What can companies do to prevent this? They can sell off their liquid assets to increase their cash flow to make their future earnings look more favorable and thus keep their company afloat. Have we seen this happen? Yes. Look at blue chip stocks. All you need to do is look at the stock market. All you need to do is look at cryptocurrency market. Companies have been leveraging off their position. They've been scaling out of the markets to increase their cash flows, and the markets are tanking. And we told you about all of this months ago before it happened. It was super obvious. The fact that not many people saw it coming is mind-boggling. It is absolutely mind-boggling. It's very obvious. Now, if interest rates continue to rise, interest on debt will continue to rise. If interest on debt continues to rise, these companies will continue to offload assets to cash. All right, assets to cash. What does that do? It increases the DXY. That is why the DXY is increasing. And it also lowers the value of assets. All right. On the flip side, if you're a retail investor, maybe you got a mortgage, maybe you got small term or short term loans that you're paying interest on. What does that do? Well, it decreases your available household cash flow. If you decrease your cash flow, you have less money to invest. Maybe you're more likely to liquidate your investments to increase your cash flow to repay the obligations on these debts, or just to be able to afford the cost of living. because the cost of living is rising massively due to inflation throwing off the demand supply balance. So you have this obligation of a situation now where we've got increasing interest rates, inflation is going up, it's not going down, and it's going to lead to a situation called stagflation, and it is going to result in an economic crash, which we're already seeing essentially we're seeing the beginning of that. We're seeing the basis, we're seeing the starting point of that happening, and it's only going to get worse, guys. I'm not trying to fearmonger you, it is only going to get worse. Now, this is where it becomes really interesting. Bitcoin has never been through a situation like this before, and we don't really know how it will respond in the long term. Yes, it's had an initial sell-off. And yes, Bitcoin is a risk asset, so it follows the same principles as we talked about here, like shares and property. All right, it will be sold off like it is, but we don't actually know how it could survive in the long term. We don't know whether it's going to crash. We don't know if it's going to continue upwards. It is very tricky to say. So all we can say is we can lump it in the same category of assets that we have data on, which is these other risk assets like shares. And we know they perform badly in times of economic downturn, and we've seen Bitcoin perform badly. But if this continues for another year, where interest rates are rising, it's hard to say what Bitcoin is going to do. Are we going to bottom out? Are we going to bottom out at 24K? Are we going to bottom out at 18K and continue upwards? Or are we going to crash through this level and go downwards? And I think the only thing you can do now is wait, be patient, be aware. I think be aware is the big one, and react. I wouldn't even try to predict that far ahead. Our prediction so far has hit our money, hit our target. We predicted the top. We told you guys 35K. We went to 35K. We told you 48K was a bear trap, a bull trap. It was an inverted, it was a bear flag. It was an ascending channel. It was bearish. We told you 24K next. We basically hit that 26K, super close. 200-day moving averages coming up. All our indicators so far being correct. And we're saying now, guys, if we lose the 24K line, we will see the price bottom here. All right. And if I'm wrong, if we don't bottom here and we bottom right now, say this is the bottom right now, we still have our bullish targets. We still know what we're going to do. We still have these validation points. If the price breaks above these levels, we know to enter. We know the trend will flip and we can still make money. And it's not like we're not trading. We've been trading this entire time. We are still profiting. You're still making money. The question is not whether should you stop trading or start trading. The whole question is, when is it a good time to enter for the long term? And that has been the objective of a question that we've been trying to answer for the last few months. And that is a question that remains on the table. All right. So moving on to the community question. Okay guys, so the next part, we're going to talk about our question, and the question states, as a trader who has a basic knowledge of risk management, stop losses and TA, I often find myself falling into emotional states. How can I keep my emotions in control? So, really good question. Personally, the best way to keep your emotions in control is to set a guideline, a bunch of principles and rules that you follow for every single trade. It holds you accountable to the rules, and it prevents you from falling into emotional states and manipulating your positions based on how you feel. All right, so my rules are, number one, do not trade or do not continue to trade if the first trade of your day is a loss. All right, this will generally set you up for failure. If you've lost your first trade, this is a subjective rule, of course. You'll most likely be more emotional, you'll most likely make more rational decisions, and you most likely won't make as many profits. The next one is always calculate your risk reward in both possible directions before entering a trade. So you should always determine your maximum dollar loss in your trade before you enter, and you should entirely accept that loss before you enter a trade. For example, if you put $100,000 in a coin with 10% stop loss, it's a $10,000 risk. Before you enter that trade, before you click purchase, you have to say to yourself, I'm entirely accepting the potential to lose this $10,000, and you will enter that trade knowing that. All right, the reason why we say that is because if you enter the trade without knowing that, and without accepting that, you're more likely to panic when the price goes down and adjust your position before the trade actually finishes and closes, and it could actually reverse and you could end up selling too soon. So that's a really important one. The next one I really like to use is never try catch up on a trade. If the trade moves past your entry point, don't try chase it. Wait for it to regain your entry point or move on to another trade. And the next one is I never really look at trading into market manipulation in the sense that I expect market manipulation, but I don't trade into global events or news. I think the price is too volatile. I find it can mess up with your emotions as the price can move so quickly. So how can you keep your emotions in check? I think the best way to do it is to set, this is a couple, I've got about 10 or 15, but this is a couple I want to share with you. Set a bunch of rules on a piece of paper, stick it next to your computer or wherever you trade. Have a checklist of things that you are going to do every single time you trade, and keep it as similar as possible. Keep every single trade as similar as possible, in the sense that you have this set strategy that you follow and you stick to every single time. Keep it mechanical. The more opportunity you give yourself to edit trades, the more likely you are to make emotional and irrational decisions. And even myself as a professional trader, I make sure that I have a set bunch of, I use 10 separate rules to make sure I am following my exact strategy every single time. It is very easy to get caught up in emotions when trading, even if you understand your TA, even if you know your stop losses. It is easy to fall into a trap. You need to be fully aware of the trade, the risks, and etc. before you enter. All right, hope that answers your question. So just to summarize, the best piece of advice I can give is to make a trading plan. Have a bunch of rules that you follow every single time to make every trade as similar as possible, and stick to it. All right, thanks guys. I'll catch you in the next video.